My greetings to everyone. In the ongoing series of Finance for Everyone, today we will be discussing on tax on short-term capital gains. The flow of the lecture will be like this. We will be talking about the meaning of the capital gains, followed by the characteristics of the capital gain, the types of the short-term capital gain, how to formulate and calculate the short-term capital gain, some illustrations, the tax structure, and the comparison of the tax rate for the short term and for the long run, and the implications of it, followed by the strategies and the real world examples. So let me start with the concept of short term capital gains. Now starting with the meaning and the concept of the capital gain. A capital gain is a rise in an asset's value that generates a profit, and when the asset is sold, such as stocks, real estate, or a business. Here are a few explanations from the various writers. A capital gain is the difference between the price at which an asset was purchased and the price at which it is sold. This is according to Dave Ramsey, an author and a personal money expert. Followed by a definition by Investopedia. A capital gain is a profit that results when an investor sells a capital asset for more than a purchase price. The third is by Charles. A capital gain is an increase in an asset value over its purchase price, resulting in a profit when the asset is sold. Similarly, we have a definition by personal finance website, The Balance. A capital gain is the difference between the price received when an asset is sold for a profit and the price paid for the asset. So in general, a capital gain is a good financial result that happens when an asset is sold for more than it cost to buy it. So let us now discuss the characteristics of the capital gain. Following are some of the essential traits of the capital gain. When an asset is sold or otherwise disposed of for more than it was originally purchased, for the capital gain are realized. And the capital gains are a type of the income that must be reported on the tax returns. The tax rate will depend on the kind of an asset, how long it was held, and the taxpayer income levels. So the third point is about depending on how long an asset was kept before being sold, and the capital gains may be short term or a long term. So the tax rate on the short term capital gains is often greater than the tax rate on the long term capital gains. Next is we have the capital losses. The capital losses can be used to offset the capital gains. An investor must be able to use a loss on an asset sale to offset the capital gain from other investments, and if the item is sold or less than the initial purchase price. A number of assets, including the stocks, properties, and the companies, can result in the capital gains. And since the value of the asset can be rise sharply over the extended period of time, the capital gains are a way to accumulate the wealth over time. So overall capital gains are a significant part of many investing strategies and for the investor who wish to make wise decisions regarding their portfolio. So it is essential to grasp their features. Now coming on to the types of the capital gains, the long-term capital gains and the short-term capital gains. They are primarily two categories of the capital profits. The duration of ownership of the asset prior to sale is the primary distinction between these two categories of the capital gains. The first is a short-term capital gain. When an asset is sold or otherwise disposed of within a year after purchase, the short-term capital gains are realized. And since these gains are taxed at a higher rate than the long-term capital gains, the amount of taxes owned by an investor may be significantly affected. Now coming on to the second type, that is the long-term capital gains. When an asset is kept for a longer than a year before being sold, long-term capital gains are realized. The long-term investors may find these earnings more appealing because they are typically taxed at a lower rate than the short-term capital gains. The investors should be aware of the following additional types of capital gains in addition to these two primary ones. Next is your gains for collectibles. So if an investor makes a profit on a sale of a collectible such as an artwork or a rare coin, they may be subject to a higher rate on their capital gains. Next is about the gains recognized under section 1256. The gains recognized under section 1256 are obtained from the investments in the future contracts, the option on the future contracts and the specific foreign currency contracts. So these gains are subject to taxation at a rate that is higher than the long-term capital gains but lower than the short-term capital gains. So in general, a key component of creating a successful investment strategy is having a solid understanding of the various types of the capital gains and how they are taxed. Now coming on to the short-term capital gain. The profit from the sale of an asset that has been owned for less than a year is referred to as a short-term capital gain compared to a long-term capital gain which are realized from the sale of the asset held for more than a year. So this sort of gain is subject to differing tax rates. The tax rate that applies to an individual income band is applied to a short-term capital gain which are classified as a regular income. According to United States current tax regulation, an individual short-term capital gain tax rate can be between 10% and 37%. It is very important to give the global point of view in this respect of the capital gains. So that is why an example of the US tax structure is given here. Next is a formula for calculating the short-term capital gain. The following equation is used to determine the short-term capital gains. The sale price minus the cost basis minus the expenses is equal to the short-term capital gains, where sale price is the entire sum received once the asset has been sold. The cost basis consists of the asset's initial purchase price plus any associated commissions, fees and the closing cost. The expenses are all costs related to selling the item such as the marketing expenses or the attorney fees. You must include the short-term capital gains in your taxable income for the year after you have calculated them. The tax rate on the long-term capital gains is typically lower than the tax rate on the short-term capital gains, which is generally much higher. Therefore, when making investment decisions, it is very crucial to consider the tax ramifications of the short-term capital gains. Now, let me give you an illustration of how to calculate the short-term capital gain. Using the following example, we can determine the short-term capital gains. Consider purchasing the 100 shares of an XYZ stock in January for Rs 50 per share and selling them in March for a price of 70 per share. For buying the shares, you gave your broker a Rs 10 commission, for selling them Rs 15 commission. So your short-term capital gains would be determined by applying the particular formula. The sale price less the cost basis less the expenses equals the short-term capital gains. So here the sale price is equal to 7,000, that is 100 shares at the rate of 70 each. The cost basis 100 shares at the rate of 50, a share of Rs 5,000. plus rupees 10 in commission for buying and selling of the shares, or rupees 5,125 in total. Cost of rupees 10 for commission to buy and 15 for commission to sell. So with these particular values which we enter into the formula, we obtain the short-term capital gains, that is 7,000 minus rupees 5,025 minus rupees 25 is rupees 1950. So rupees 1,950 is a short-term capital gain which results from the sale of XYZ stock. The person will be required to pay rupees 468 in taxes on the gain, that is 24% of 1950. So if this is the only short-term capital gain for the year and they are in 24% tax rate. So please take a note here that this is only an illustration that the actual tax rate and the other elements may change based on the circumstances. So this was just to explain the particular concept of how to calculate the short term, the capital gains. And to receive the individualized guidance on how to manage your investments and taxes, it is very crucial and critical to speak to your tax consultant, the tax expert, or a financial counselor. So coming on to the tax structure for the short-term capital gains. The short-term capital gains, we call it as STCG, are taxed in India according to the individual income tax rate bracket. So the tax rate that applies to STCG are identical to those that apply to the normal income. The following tax rates apply to the people for the fiscal year 2022 and 2023. The tax free up to INR 2.5 lakhs, from 2.5 to 5 lakh Indian rupees is 5%, from 5 to 7.5 lakh Indian rupees is 10%, from 7.5 to 10 lakh Indian rupees is 15%, and then 10% to 12.5 lakhs Indian rupees. And from 12.5 to 15 lakh of Indian rupees is 25%, and over 15 lakhs INR, the tax rate is 30%. So for instance, if a person had an STCG of INR 1 lakh and is subject to a 20% tax rate, their STCG would be subject to INR 20,000 in taxes. That is 20% of INR 1 lakh. It is also very crucial to keep in mind that the assets kept for less than 36 months are subject to short-term capital gains tax rates in India. The long-term capital gains are assets that have been held for more than 36 months and are taxed at a separate rate. Now let us do the comparison of the tax rates for the short term as well as for the long term. In India, the tax structures for short term capital gains and the long term capital gains are distinct and are the tax rates imposed on each category of the gain. The gains from the sale of an asset held for less than 36 months are subject to short-term capital gain tax at an individual income tax bracket rates. As I noted in many earlier responses, the tax rates for the short-term capital gains are the same as the tax rate that apply to a regular income. So the long-term capital gains, on the other hand, are the profits from the sale of an asset held for a longer than 36 months. So this type of assets being sold affects the tax rates for the long-term capital gains. Now if the long-term capital gain exceeds 1 lakh Indian rupees in a fiscal year for the listed equity shares and equities oriented mutual funds, it is taxed at a rate of 10%. exempt from indexation. So, there is no tax due if the long term capital gains is less than 1 lakh of Indian rupees. So, indexation benefits lower the amount of tax paid by adjusting the assets acquisition price to account for inflation. So, LGCT is taxed at a rate of 20% with an indexation. Benefit for the debt-oriented mutual funds. The asset is taxed according to the individual income tax slab rates, and if it is capped for the fewer than 36 months. So, the long-term capital assets include the real estate holding as well, which are subject to LTCG, that is the long-term capital gains taxation at a rate of 20%. So, with an indexation advantage, the short-term capital gains are those that results from holding an asset for less than 24 months, and they are taxed according to the individual income slab rates. The short-term capital gains, that is STCG, are taxed according to an individual income tax slab rates, whereas the long-term capital gains, that is the LTCG, are taxed at a separate rate based on the type of asset being sold. Investors are encouraged to keep on to assets for a longer length of the time because the tax rates for the long-term capital gains are often lower than the tax rates of short-term capital gains. Now moving on to the implication part of the short-term capital gains. The profits from the sale of assets like stocks or the real estate held for less than a year are referred to as a short-term capital gain. Depending on one's income level, the ordinary income tax rate, which ranges from 10% to 37%, is applied to these gains, and it is vital to understand that the long-term capital gains, that is the assets held for more than a year, are taxed at a lower rate of 0%, 15% or 20% depending on the individual's income, whereas the short-term capital gains are taxed differently. In addition, depending on where the person lives, the short-term capital gains can also be liable to state and the municipal taxes. Now, overall, it's very crucial to consider the tax ramifications of the short-term capital gains when making the investment decisions, and also to seek out the individualized guidance from a tax expert. Now, coming on to the impact of the short-term capital gain on overall tax liability. An individual entire tax obligation may be significantly impacted by short-term capital gains. The profits from sale of an asset held for less than a year are regarded as short-term capital gains and are subject to ordinary income tax at the individual marginal tax rates. This implies that a person may be subjected to a higher tax rate on their short-term capital gains, and if they have a higher income, state and local taxes, it may also apply to short-term capital gains, increasing the overall tax obligations. So, let's use the example of a person with a total income of rupees 1 lakh who sells an asset for a profit of 10,000 after keeping it for 6 months to demonstrate the effect of short-term capital gains. Ordinary income tax rates would apply to 10,000 profit, and depending on the taxpayer's tax level, they may reach 24%. So, there would be 2,400 tax obligation as a result. On the other hand, the gains would be regarded as a long-term capital gain if the person had owned the asset for more than a year before selling it for a profit. Depending on the taxpayer's income level, long-term capital gains are taxed at a rate that is lower than the short-term capital gains, ranging from 0% to 20%. Now, in the same scenario, the person would be liable to a long-term capital gain tax rates, which could be as low as 0%. And if they had owned the asset for more than a year and sold it for a profit of 10,000, the tax liability would significantly reduce as a result, potentially saving the person's thousands of rupees. So therefore, before selling the asset, people should think about the tax ramifications, and it may be advantageous to hold off on selling the item until it has been owned for more than a year in order to qualify for the lower long-term capital gains tax rates. As an alternative, people should think about investing in tax-advantaged accounts like 401k plans, IRA or health saving accounts, that is HSAs, to lower their tax benefits and the tax burdens. The tax advantages, including tax deferred growth, tax deductible contributions, or tax-free withdrawals, are available through these accounts. The tax loss harvesting in an additional method for reducing the tax on the asset transactions. So, selling assets whose value has decreased is necessary to offset the capital gains from the other assets. A person would be taxed on a net gain of 5,000, and for instance, if they sold an asset for a profit of 10,000 and another for a loss of 5,000, the loss from the second asset may be carried out to a subsequent year or to be used to offset gains from the previous transactions. So, in conclusion, we can say managing one's money effectively requires a grasp of tax ramifications of selling assets. Individuals can dramatically cut their tax burden on the assets, sales by using the tax advantage accounts, holding on to assets until they are eligible for a lower tax rates, and using a tax loss harvesting tactics. A financial advisor or a tax expert may be able to help you decide the best course of action for minimizing the taxes on asset sales depending on your own unique situation and objectives. A person can make educated decisions regarding selling assets and handling their finances by keeping up with the changes in the taxes, rules and regulations, and in general, reducing the taxes on the asset sales is a very crucial part of accumulating and protecting the wealth over time. Now, strategies for minimizing the short-term capital gains. When the assets are kept for less than a year before being sold, the short-term capital gains are generated and they are taxed more heavily than the long-term capital gains. Hence, here are some of the methods for reducing the short-term capital gain taxes. Retain your assets for at least a year. The long-term capital gains tax treatment, which has reduced the tax rates, is available when you retain your assets for longer than a year. Equalize the profits with the losses. If you have sold the assets for a profit, selling stocks or other securities as a loss will assist you equalize the taxable gain and the timing assets sales to remain in the lower tax brackets. So people can reduce the overall amount of taxes due on the short-term capital gains by timing assets sales to remain in the lower tax bands. Next is your investment in tax advantage accounts. Because these accounts offer a tax deferred or a tax free growth on the assets, investments in tax advantaged accounts like IRA, 401ks and other retirement plans can assist minimize the taxes on the short-term capital gains and also take into account the tax loss harvesting, develop an investment strategy with the help of a financial advisor. So, also overall careful timings, smart selling and the tax efficient investments are necessary to reduce the short-term capital gain taxes, and the investors can lessen their tax burden and keep more than their investment profits by keeping up with the tax legislations and consulting a financial counselor. So, the real world example of a short-term capital gain. Here is the last illustration of this. Let us say Mr. John purchased 100 shares of XYZ company, and on 1st 2021 for rupees 50, then on March he sells it the entire for 60. So he makes a capital gain of 1000 as a result of rupees 6000. And this capital gain is seen as a short-term capital gain because Mr. John owned the shares for less than a year, and John may be required to pay taxes on his gains at an ordinary income tax rate which may range from 10 to 37% depending upon the tax bracket. So all these points have to be kept in mind, and in general it's very crucial to comprehend the tax ramifications of purchasing and selling the assets while making investments in the stock market or any other type of asset. And in summary, we can say the short-term capital gains are earnings realized from the sale of an asset within a year of the asset's acquisition. Thank you so much.